This is Michael Fox, and this is the Prospector News Podcast. And joining me today, we have a special guest. We have Cynthia Urda Kassis, who's the co-head of the Mining and Metals Group of Shearman and Sterling of New York. Welcome, Cynthia.
Thank you, Michael. Thank you for having me.
Not a problem. I am pretty certain that my listeners are not familiar with your firm and your division of that firm. Can you enlighten them?
Sure, of course. I'm with Shearman and Sterling. Shearman and Sterling is an international law firm. I am based in New York, and that was our original head office, but now we have offices in a number of countries around the world. One of the key industries that we focus on is the mining and metals industry, and we have for quite a long time. Our practice is quite broad, covers really all of our offices around the world, projects and companies located pretty much everywhere. We work with mining companies, small, medium, and large, as well as a lot of the other participants in the industry, be they traditional investors or the so-called alternative investors, being things such as streams and royalty financiers and commodity traders and funds and, SPACs, you name it. And we do all different kinds of transactions in this industry, mergers and acquisitions, capital markets, project development and financing, antitrust issues. We handle disputes, arbitrations, litigations. So it's a quite broad practice.
Wonderful. The reason we brought you on today is we wanted to discuss how to bring the financial development of critical metals to the marketplace, which is an area of expertise your firm has.
Yes, and it is it's quite a fascinating area at the moment. A lot of change. Maybe, Michael, we start and make sure we're all on the same page in terms of when we talk about critical minerals or critical metals, what we're referring to, because I think there's a lot of different definitions floating around out there. Some call it critical minerals or critical metals. Some call it strategic minerals. Some call it, battery metals, EV metals. There's a variety of different names. Some of them official names from different countries, some of them just colloquial references. But I guess what I was thinking we might focus on is critical minerals, which are pretty fundamental to the energy transition that we're going through right now. The move from combustion engines to EVs, the move from some of the fossil fuel energy generation facilities to more renewables, and the minerals and metals that are really needed in order to make that evolution happen. So that it does include some from very traditional minerals such as copper and nickel and PGMs and things like that, but it also covers whole series of minerals and metals that some of which I can't even pronounce, but it does include lithium. It includes cobalt, graphite, tin, rare earths, vanadium, and things like that. And maybe it's that second bucket that's worth spending some time talking about, because I think that's more challenging in terms of finding the funding necessary to develop the amount of resources that are reported to be needed in order to fuel this revolution. I mean, I think a lot of what I read talks about copper deficit and everything else, but I think there are a number of sources that are comfortable funding those developments. I think there's a lot of structures that have been used successfully over a long period of time, that to the extent those resources are there and ready to be developed, I think you can find funding for it. But these more unusual, esoteric, new minerals and metals, they're I think they're a little bit more, it's a little bit more challenging to find the funding to do that.
Yeah, that's if you can't pronounce it, they're probably a little bit harder to fund. But ultimately, is this not an approach that's being brought forward by the Western governments to break the Chinese monopoly on the production of and processing of the rare earth metals?
Mm-hmm. Well, I think there's two things. I think you're absolutely right that there is part of what's driving some of this development is the idea that there are, certain of these minerals and metals are they're critical, hence their name, to the development of these technologies, to the production of these technologies, and they're where they are found and where they're mined now and where they're processed now is, for in the case of a number of them, is pretty concentrated, right? There's not much diversification. Whether it's a pretty high monopoly in China, or in the case of cobalt, a lot of it coming out of the high percentage coming out of the DRC, certain others, a high percentage maybe coming out of Russia and other of their allies. There is a sense that for certain of these, the sourcing of it can be somewhat unstable, either because of geopolitical developments or because of local developments, if there are, increased security issues, civil war type issues, and it's just in one jurisdiction, right? There may also be issues about ethical sourcing in terms of the methodologies used, the labor arrangements and all of that in some of these jurisdictions. So I think part of it is driven by where some of these metals and minerals are coming from, and the very limited number of places they're coming from or from which they can be processed. I think another part of it is the fact that there's just the demand is increased significantly and is projected to be skyrocketing in the near to medium term. And there's just not, that's historically, there hasn't been that kind of demand. So there just aren't that many sources of it to start with, leaving aside, where they are. So I think, and given, as we all know, the period of time it takes these days in most jurisdictions to, find, develop, construct, and begin operation of a mine, that's quite substantial timeline in most places.
Yeah, in some countries it can be as long as 20 years to get a mine to permit, just to get it operational. Is the deficits in these metals going to hold back the dream of a new green economy?
Well, I think that's the question, and I think that's part of why there's such a focus on this from a number of jurisdictions, in particular, Canada, the US, European jurisdictions, Australia, Japan, to name a few. I think there is certainly, in what I read and those that we talk to regularly in the industry, there is a concern that it is going to hold it back, and trying to find ways so that that's not the case, whether it's ramping up recycling, which maybe can cover a bit of this, trying to sort of reform the permitting process and the approval process in some jurisdictions, the idea of maybe working hard on the science of the processing of some of these minerals, one, to make it more environmentally friendly, and two, to make it more efficient in terms of the yield you get of mine minerals and metals which meet specification. So I think there's a lot of ways people are trying to address it, but agree 100% that's a fear that's driving a lot of the activity.
Now, the move from Western governments towards for the lack of a better term, even though it's really not a nationalization, I guess it's a regionalization of these critical metals. Is it not just, putting it back to basics? Is it not just an effort to reduce country risk in the projects?
I think it's interesting. I mean, I think that in a putting a sort of a new light on it, a new slant on it, maybe I would guess it's less that that all the really good high grade resources have been found in the main jurisdictions, right? And so we have been over the last decade or so reaching further and further into jurisdictions which are more emerging, more frontier, right? So have less well-established and mature, say, legal systems, particularly when it comes in some cases to the kinds of regulations that you need to develop these projects. So, but that hasn't stopped people thus far from reaching further and further and being willing to take on sort of more, I guess you call it political risk in a way. I think this really is more driven, less by wanting to avoid the frontier jurisdictions for old-fashioned political risk reasons, and more this realignment geopolitically of the world, and realizing that things can go sideways quickly, and it just isn't prudent in anything you do to have too much dependency in any one place for something that's so fundamental, both because you could find yourself on opposite sides of a major political issue. You could also find yourself in a situation where, even though you're not on opposite sides, it's very difficult. It's significant delays in the shipment of the product that you need from one place to another. I mean, I think there's a number of reasons that were particularly highlighted during the pandemic, and by the Ukrainian war, and other recent developments, to show that it's really good to have diversity, and it's really good to have some of those sources of those critical items onshore or near shore, as they say.
Yeah, I'm afraid Germany's kind of finding that lesson the hard way with their natural gas coming from Russia. Let's talk a little bit about how ESG can factor into these discussions. I was on the outside of a panel at the Mines and Money event in London recently, and they were discussing ESG. And I threw a dart into the middle of the roundtable, saying that at the end of the day, the state-owned entities that are operating mines across the world, and we both have touched upon the DRC and Cobalt, they don't care about ESG. They never have to go to a marketplace to raise capital to mine. So ESG is irrelevant. How, as we move to more local, is ESG going to become increasingly more relevant or increasingly less relevant as we have to compete with those other jurisdictions?
I think ESG, I think it's here to stay, and it's going to stay, very relevant. And I say that in part because certainly at the moment, and it doesn't show any signs of abatement, it's really the market talking. It's the big investors, the managers of the big pension funds, and even state, city, municipal retirement funds, sovereign wealth funds, and so forth, which are the source of a lot of the funding for a lot of these companies. And it's quite clear that one of the top boxes that need to be checked when they make an investment, whether they're making an investment in publicly traded equities or public debt, or down at a project level, or in terms of, making funds available on grant or other bases to try to, catalyze investment in new technology. However it is that they're putting that money that they have to work, ESG is at the top of the list of things they check first, frankly, on a yes or no basis. Is this investment going forward? Yes or no? Good ESG, yes. Bad ESG, no.
So where the rubber hits the road based on the experiences of your firm, then let's use the cobalt as the example in this case. It'd be much easier for you to find funding for a cobalt project in, say, Eastern Canada than you would to fund a cobalt project in, say, the DRC.
I think that's right. Although the DRC is pushing hard to go through a new kind of a renaissance, but I would say yes. I mean, I think that to the extent any project, cobalt or otherwise, is looking for funding, if they're in a jurisdiction whose reputation is tarnished when it comes to ESG matters, whether it's on an environmental side, on the social community relations side, or governance in terms of compliance, corruption, that kind of side. I think it's just it's harder. There are certain institutions that place very high premium on avoiding reputational risk for their institutions. And so if you have an element of your project, which could include, where it's located, that raises that red flag, they're going to avoid it. It's not going to be the top of their list.
As Western governments have increasingly become cognizant that these metals are going to be crucial to decarbonizing the economy and moving things forward, they've been putting out a number of programs and policies to get these critical metals closer to home. And there's been an awful lot of carrots that are dangled out by various governments here in the West. How much of a factor does those government carrots have to the people that ultimately are going to be financing these projects?
I think that as of now, that effort is just beginning to roll itself out. I suspect that it's going to be actually important, and it is going to allow some transactions, some developments to go forward which otherwise wouldn't, because for a number of these, particularly these non-traditional yet critical minerals, where there really isn't a history or a relevant history of demand and price, right? And there is technology risk in terms of substitution, in terms of how quickly are EVs going to come online? Is the demand curve straight up? Is it sloping up? How much of a slope of an incline is it? How steep? So there's a lot of risks which investors to the mines and metals industry look at when they make their decision to invest, and in which over the years, decades, they have come up with ways of analyzing those risks and different aspects that make them comfortable with risks, particularly how they mitigate or how they get comfortable with demand risk, with price risk, with technology risk, and things like that, which these critical minerals, you can't rely on the customary way of addressing those risks, right? So you have to come up with, you still have to deal with those risks, but you have to come up with new ways of doing it, new ways of analyzing it, new ways of sort of perhaps not parsing each risk individually, but looking at the investment as a whole and pulling, reducing the amount of leverage for a particular project in order to get comfortable with the risk. And one way to reduce the amount of leverage is if some of the funding is coming from governments, either in the form of grants or in the form of concessionary financing or in the form of, sort of subordinated financing, that or in terms of, tax credits, any number of things which can be used to, become a factor in analyzing the financial model for the project to lower what's the overall risk profile, and so that it's viewed that there's more cushion there. There's more cushion to allow for a delay, more cushion if the demand isn't exactly what was originally projected in the base case, if the pricing is softer than anticipated.
So the carrots are definitely going to have a positive impact on things. The other side of that yin and yang is the stick. There's the carrot and then there's the stick. And it's been a long time since I thought we'd be talking about nationalism in mining, but here we go. The Canadian government just recently has forced the divestment of some state-owned entities in Canadian mining projects. Is this going to become increasingly an issue going forward, where countries are going to try and have some degree of semi-nationalism to their mining projects again?
It's an interesting question, Michael. I guess in a couple of different ways. One is, it's interesting, as you mentioned, it's Canada, right? And normally when I think about resource nationalism, I think more about frontier jurisdictions, emerging market jurisdictions, which for nationalist, usually people would say more on the left side of the political spectrum, where they're talking about taking back their national resources from the foreign investors who are pulling the gold, literally or figuratively, out of the ground and shipping it elsewhere, with all of the real profit being arising outside of the jurisdiction, and so pulling this wasting asset out and leaving nothing left but things that need to be cleaned up. So I normally think of it in that context, although I concede that it wasn't that many years ago when there were sort of changes to royalty regimes and tax regimes, which hit not only those jurisdictions, but jurisdictions like Australia and Chile and others, which one doesn't normally think fall in that bucket. This is, I think, a different type of nationalism, in the sense of it's really geopolitical, national security driven kind of nationalism. And it's query how long this will last. Is this a temporary situation based on what's happening in the Ukraine and maybe what's going to happen in Taiwan? Is that what's driving this, and it'll fall away relatively quickly? I don't know. I think this is a very tricky thing for governments to try to address, because I'm not sure it's as simple as just saying you can't own that mine. You can't own the equity in that mine. You can't control the equity of the company that owns that mine, or any company up the chain, because it's not so much that. I mean, you'd have to say you can't do that. You can't own a stream. You can't have a royalty. You can't be the purchaser of the product directly or indirectly that's shipped out. You can't be the processor of the product. I mean, there's so many ways in which the mineral that's being produced can flow over to the jurisdiction you're trying to block, that you'd have to have a pretty, I think, sophisticated and intricate set of regulations to really stop that.
I see. So far that stick has been basically putting a Band-Aid on an aneurysm.
Could be.
Okay. Well, we barely touched upon this topic, but coming up, actually within just a few weeks into the new year, you're going to be doing a presentation for an online event that's being put on by the New York division of the Society of Metallurgical Engineers. Can you tell me a little bit about that?
Sure, yeah. SME New York is issuing a virtual, symposium that's covering this and related topics. And actually, I'm moderating a roundtable discussion which is quite interesting, I think, because it brings together representatives of three very different types of investors in this sector and with respect to these kinds of projects to get their views on the challenges of financing developments in these critical minerals. So we have a representative of one of the major international commercial banks, Société Générale, Laneig Trudeau, who heads their global mining and metals group, who will be speaking from the point of view of international commercial banks. It's Sachin is well known in this sector as a lender to the sector, and takes a very innovative approach on how they finance these kinds of projects. Then we have Alice England, who's from Ikura, which was formerly called Anglo Pacific. It's a royalty and streaming company, and obviously becoming more and more mainstream. Royalty and streaming companies, one might say they are mainstream now, but their rocket-like rise to being major investors in the sector over the past decade and a half is sort of very well known and discussed in great detail. And then lastly, we have Kate Southwell, who's from Pala Investments, a fund, a private equity fund, which focuses on not only the mines and metals sector, but specifically on critical minerals. Copper included in there, but also cobalt, tin, and lithium, other minerals that fall into the definition we talked about. So I think it'll be an interesting discussion from those three angles in terms of what they look for when they're considering investments in these types of projects, and what they find most intriguing and most challenging when they look at these projects.
Yes, definitely. I think we haven't heard the last of the issues around the critical metals and the changes in the geopolitics. Now, the videos for these programs that the New York SME is putting on are all available on demand. We're going to put up a link at the bottom of the description of what Cynthia and I have talked about today that allow you to register. I believe the registration is for free. It's an educational program that'll allow you to hear Cynthia's roundtable, as well as the other discussions that are going to be put forward that day. So, and again, it's on demand, so it won't be where you have to be there at a specific time or you're going to miss out. So, Cynthia, thank you very much. And as this rolls out over the next year, I'm sure you and I are going to have plenty of opportunities to revisit our chat and to look forward to the changes in the industry.
Great. Well, I look forward to that, Michael, and thank you very much for having me today.
You bet. Thank you, Cynthia. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.